Hello and welcome to this latest edition of Courses on Demand brought to you by Forex.academy. In this particular course, we will be discussing correlated markets. Now, there is, of course, inherent risk when deciding to trade these financial markets. So just before we do begin, please take a moment to familiarize yourself with the following disclaimer. So the objective of this particular webinar is to define correlations. Across different asset classes, we have various markets that are both negatively and positively correlated. And the purpose, again, of this lesson is not just to define that, but to look to see how it can help us provide trading opportunities. Traditionally, we look at these financial markets as instruments to look to perhaps buy something and sell it at a higher price to make profit, or perhaps to short sell and make speculative profits to the downside. But there are many different ways within these financial markets to trade and make profits. Just by observing correlations and perhaps spreading risk across different assets is one of them. And we'll discuss many different opportunities in different trading strategies that will highlight these opportunities. So first and foremost, let us define what exactly correlation is itself. Correlation is a statistical measure that determines how assets move in relation to one another. It can be used for any financial security, but it is often aimed at markets within the same asset class. So if we think logically about that, what we're looking for in terms of defining these correlations in the markets is perhaps one or two or three asset classes or markets that are sharing the same characteristics and obviously are affected by price in such a similar manner. It is expressed as either a percentage or as a relation to one. A perfect positive correlation between two assets has a reading of +1, whilst a perfect negative correlation has a reading of -1. Correlations will be expressed more often as a decimal, for example, as 0.684. During times of instability, many international stock markets become highly correlated as investors analyze the risk of similar securities in their portfolios. Okay, so a lot of these asset classes themselves simply share correlations as a result of the type of risk premium they hold within the investor community. So to give you or name out a few examples, we have the equity markets, given they're as an investment more riskier than perhaps the bond markets, they will share an element of correlation. And of course, the bond markets themselves will share separate elements of correlation depending on the maturity and the risk association. Let's define positive correlations themselves. Positive correlations describe two or more markets where their prices move closely in relation to one another. So what we have on screen here is the gold market. And as you can see, as silver comes on top of our gold market trade analysis, we can see it follows to a larger extent the large price swings in both markets here very closely indeed. So when we see large increases in the price of gold, we're likely to see large increases in the price of silver. Again, fundamentally, why is this? Well, number one being the fact that they are both well-valued precious metals, and they're, of course, both priced in US dollars and traded in US dollars across financial markets. They also share the same relation to the US dollar that they were initially on the gold standard and came off to reflect free market operations and traded against the dollar as such in terms of investment trading within the overall global landscape. So they have a very positive correlation. So we often see market participants looking to trade these assets when we see times of fear enter the markets because they're precious metals. We'll see both assets see very large price shocks. They also have very stringent ties to things like inflation and a lot of other domestic and global economic data that will look to have an influence on the economic environment overall. One example of perhaps a negative correlation with and to gold is the US dollar itself. And again, in describing this, it describes two or more markets where their prices move in opposite directions to one another. So just like the gold and silver market, where we've seen a very positive, strong correlation, we can see gold and the US dollar share a negative correlation. So over the long run, when we see the price of the US dollar, here we have the US dollar index, trade to the downside, we're likely able to see a very strong move in the opposite direction of the underlying gold market. And that is simply because the gold is priced in US dollars. Previously, it was on the gold standard, pre-Bretton Woods standards. And we've seen open markets start to dictate the currency relative to the US dollar, trading the gold market as well. If we think more logically about that as well, in terms of defining this negative correlation, let us use an example such that perhaps a bar of gold is worth $200,000. It's of course going to have a relation to the price of that currency as the price of the currency appreciates or depreciates. So if we see an appreciation of perhaps 10% in our 200,000 bar of gold, we're going to see the inverse 10% depreciation of that bar of gold relative to what it holds as US based currency total value. So of course they share this very strong negative correlation and are fully tradable as such, and providing some trading opportunity in the financial markets. So why do we look for these correlations, and why does it matter so much in terms of trading activity? Well, number one, it helps investors to choose the amount of diversification in their portfolio. If you were totally unaware as to any correlations existing in the markets, you might have way too much risk on a potential portfolio that you're outlaying for a client, or perhaps your own individual personal portfolio. And actually identifying these correlations, it can help you to prevent to have too many correlated assets on the one portfolio, and obviously then help to mitigate some of these risks in trading the financial markets. It provides insight into an overall perspective of economic performance. Correlation can increase during periods of volatility, and that's often what we see when we do see something like a very strong equity market sell-off. We see a closer or a tighter relation to those correlations within certain asset classes. So to use that as an example, given that to a certain degree, all of the equity indices globally share a level of correlation because they are, of course, equity markets, and they're sharing the same risk premium in terms of an investor deciding to invest in something as a global equity or stock in the stock market. That certainly shares the same sort of risk as in terms of trading or investing in something less risky, perhaps a government bond, perhaps a small investment trust, or many of these different assets that are available. More particularly, if we look at indices across the United States, we'll look to see a stronger correlation in the S&P and the Nasdaq 100 and the Dow Jones Industrial Average, more particularly because they are all US equity indices. They're all obviously priced in US dollars and relative to economic strength within the US economy. So, of course, these more regional equity indices will share a very stronger level of correlation. And during these periods of volatility, these correlations will get much, much stronger, much, much tighter, specifically if it is as a result of perhaps uncertainty within that economic region itself. Correlations, they help traders to manage risk by choosing assets with low correlation. And again, we'll look at portfolio diversification in a little detail here. Perhaps when we see to our previous, or refer to our previous example there with the gold and US dollar market, we know that they're very negatively correlation. So straight away, that tells us that perhaps it's not a good idea to have a long position in gold and a long position in the US dollar at the same time. More specifically, having long-term objectives for two long positions in both markets at the same time. We know that that's not a good idea because they're going to more likely move in different directions. And the final point, market correlations can prevent traders from taking too much associated risk and thus poor trade decisions. And that is something that does not get enough conversation amongst traders. Certainly it does in the professional trading world, but for retail traders, not as much. It does help you make better trading decisions, knowing that there are many asset classes correlated, perhaps. And again, we'll use the equity markets as an example. If you wanted to trade perhaps 10 trades at the same time, you wouldn't necessarily, specifically given the volatility to the downside in the equity markets when there's a shock, look to actually take the same trade across these equity markets because you know they're all correlated and you're going to be overexposed in one asset class. it can help you and prevent you to actually making an overcompensating risk and making better trading decisions. So let's discuss correlated markets. The first asset class we'll discuss is the equity markets. They all attract European business and investment. They share the same risk premia, and they all reflect fundamental health of European economies here. Here in front, we have the Euro Stoxx 50, which is the largest 50 market cap companies across Europe. So, an overall benchmark for European equities. We have the IBEX 35, which is the Spanish market index, and then we have the German DAX 30, which is of course, the German blue chip stock index there, the DAX. We can see, obviously, just by looking at the price action in the line chart, that they're very, very closely correlated. We see a very sharp move within the middle of the frame to the downside, and they all follow suit. One may lead, of course, given the news story might be more reflective on one economy, but you can see the overall bearing they're going to have in actually overall health issues in terms of judging the outlook, the overall outlook for European equities. More importantly, they may actually provide us with some trading opportunity to actually look to spread markets, and we'll discuss that through some of these webinar slides as well. What I mean is potential opportunity to actually look to understand that one of these equity markets is weak, and to look to sell that while actually spreading that risk off in another market to avoid the volatility. So we can really see the correlations between the equity markets, three particular equity markets that we wouldn't perhaps think would be so closely correlated. Again, what is relative to Spain's economy that is relative to Germany's economy will, of course, be very different, but that's not always how the market or market participants perceive these correlations. We often see them more strongly correlated, and price action will, of course, follow through to a certain degree, considering the strong correlations these European equities have, particularly if it's a European equity issue. Perhaps we have changes in sentiment of the European Central Bank. We have perhaps liquidity insurance being taken from some of these central banks across Europe. Perhaps we're going to increase quantitative easing again. These are all going to have a correlative effect due to a real Europe economic boom or bust effect on the overall equity indices and sentiment. The second asset class we look at here is the bond market. So what are the bond markets? Of course, they are the debt markets. And here we've chosen to actually outline two bond markets, particularly with a duration of 10 years. We have the US 10-year Treasury bond, or the T-bond, and then the German 10-year bond, both 10-year debt bond instruments within the financial markets there. Both markets offer investors safer long-term investment, and again, backed by government. So there is, of course, a likelihood, a very, very probable chance in investing in bonds. They are regarded as the most riskless free investment, given that, of course, you have a very strong level of confidence in the government actually paying back or committing to their debt instruments and their liabilities. So more generally speaking, depending on the yield, and obviously changes in interest rates, they will move more closely together, given that they are effectively lending instruments to two separate governments, but of the same duration. They both, of course, share the same risk premia, and that's because they are less risky than potentially equity markets, or taking long positions in some commodities where you've done your fundamental research. You know that there's going to be a level or a promise, a guarantee is essentially made by the government to repay based on the interest rate or coupon from this government bond on the actual overall investment itself, and that as prices and yields change both across these durations, you'll see that they will trade more relatively over the long term together. In the short term, they do see some very rapid price change and do see some indifference, and that's because interest rates do differ in domestic economies. Particularly at the moment, they are differentiating themselves in the US with more expedited increases, as opposed to those European markets who do seem to lag behind in terms of increasing interest rates over the year. When we move across to the commodity sector, two very obvious choices, I suppose, to trade are, is the oil market. We have US oil, WTI crude, and UK oil, which is really the Brent benchmark from North Sea drilling. They are both based on the underlying value of the same commodity. So this is perhaps one of the best examples we can use in terms of correlation. We have two oil markets here, and just simply there are two benchmarks, and one European and one US, of course. Both commodities, of course, they move as a result of supply and demand, and they differ in relation to more regional issues. So when we do see large shifts in supply, perhaps, or an increase in that supply, which has been very much the case for 2017 and leading on to 18, from fracking, which is a US process, obviously drilling into the rocks, we see a lot of US increase in supply having a very strong effect to the downside in US oil and the global oil markets. The outlook has now changed for the better, and we are seeing prices start to retrace from lows from around 40 and increasing from $50 a barrel. However, just by looking at the market in front, we can see that it does not change the correlation to a larger extent that exists in this market. We see that the price action with the line chart is very much the same in terms of price speculating from a very strong bursts to the upside and sharp moves to the downside. But what is very important to notice is that because this is actually the same commodity, that there is a difference in price, and it's based on a couple of factors, one being the quality of the oil, but mainly the supply and demand factors just regionally set between the two benchmarks. And that actually allows us for trading opportunity, which we will discuss coming towards the end of the webinar. And then, yet, just to reiterate, we have a negative correlation between the gold and the US dollar. They see many different factors that affect the price, and that is very logical to understand, because if we think of, well, both assets, the US dollar and gold, think of how many factors, how many news events or economic data that is released ongoing throughout the days actually result in price change across these two individual asset classes. We know that they are very close in terms of their correlation because of them both being priced and having a relevance on the US dollar and changes to the currency pair. But we know, of course, that gold itself will depend on market sentiment, whether there's fear or shock in the market sentiment. Of course, we'll see spikes in gold to the upside if there is. So they do price to their own extent, but do share that initial correlation. We can see both weak or strong correlations depending on the data, and that is certainly the case for intraday traders that see these assets start to drift away from their correlation given the news events more short term. But over the long term, they certainly do share a negative correlation. Perhaps one of the most important correlations that we need to be aware of in terms of trading, and particularly the Forex markets, is the Forex correlations. Now, there's two different approaches to actually assessing the fact that these pairs are correlated. Number one being that all of these Forex pairs here that I have in front are actually correlated, and there's plenty of them. The reason being is because they all are tied to the US dollar in some way or another. So these pairs where the US dollar is quoted as the quote currency will trade in the same direction in relation to the US dollar. So in red there, when we see strong moves to the US dollar, supportive of US dollar strength, we will see these markets trade to the downside. And below in blue, pairs where the US dollar is quoted as the base currency will trade in the same direction in relation to the US dollar to the upside again. So if we see a strong move supportive of US dollar strength to the upside, all of these currency pairs, given that the US dollar is the base currency, will trade to the upside. So the most important thing to really notice and understand is that it doesn't really matter in terms of trading these currency pairs whether one is quote or one is base currency. It would effectively be a hedge trade if we decide to choose to here and actually trade the Australian dollar with the US dollar and the US dollar against the yen. It doesn't really matter if we're long one or short one. We're both in the US dollar trade, and there's a level of correlation which might affect our overall profitability or the overall outlook of the trade that we're actually trying to identify. So do be aware when trading these Forex pairs that even though one is a quote and one is obviously the base currency, that there is a strong relation in terms of a positive or negative correlation to these currency pairs, but you're still effectively trading the US dollar against, in this example, Australian dollar and Japanese yen to one side or another. There is an effective hedge going on there, and it will be very difficult to formulate a trading strategy once you're in those positions, particularly if you have 3 to 4 different currency pairs, all allocated in one portfolio. So let's move across to actually deciding to spread risk in different portfolios here. Here is one example where traders choose to spread risk in Forex markets by observing their correlations. Okay. And the first thing we can see here is that it's very heavily dominated by the US dollar. What I would like to ask is, how risky is this trader's portfolio? Well, we can see the trader has chosen effectively to trade 5 correlated US dollar Forex pairs. So that's not the best idea to actually look to spread risk or diversify. The trader is therefore overexposed to fluctuations in the US dollar. Again, we have the euro dollar, the pound dollar, the Swiss franc, Japanese yen, and the Canadian dollar. I suppose the main point I would like to make that is there is a certain realization that you need to understand that you're actually effectively really trading the US dollar here. You're heavily invested in price fluctuations in the US dollar. You're not necessarily only trading the euro, the pound, the Swiss franc, the Japanese yen, and the Canadian dollar. You're effectively very heavily invested in the US dollar, of course, relative to swings in these other currency pairs. But if there's going to be news out or news flow, perhaps a change from any monetary policy with the Federal Reserve out, in the previous or next day, this is of course going to have a huge effect on the underlying value of this portfolio, given the exposure to the US dollar. So the trader has inadvertently hedged some of her positions, choosing to trade both base and quote currency dollar pairs. Let's assess here yet another portfolio of Forex pairs. Here we have a different selection of currency pairs to trade. Again, the question is, how risky is this trader's portfolio? What we can see is we have a euro US dollar, the pound Swiss franc, the Canadian loonie or dollar against the Japanese yen, the Australian dollar against the New Zealand dollar, and the US dollar against the ruble. So we do have two US dollar pairs in there, but they're trading two very different currencies cross section as well. The trader has chosen to diversify with a portfolio of diversified Forex pairs. And what we can see is that we have one euro construct really within these selection of pairs. We have £1, one Swiss franc, one Canadian dollar, one Japanese yen, and so forth. So it is a very, very well diversified portfolio. We do, of course, have the US dollar against the euro and the US dollar against the ruble, but again, they are going to trade very much in relation to how the euro and the ruble is trading. So there is a good level of diversification there. The portfolio is not overexposed to any one particular currency, and the trader can now treat each individual trade differently and judge them on their own merits. And that's a very important point. It's very difficult to judge the performance of your portfolio if you have selected, 5 or 6 different currency pairs that are all relative to the euro, or they're all relative to the US dollar, or they're all pegged to the dollar or another currency similarly. So you're not able to actually judge your portfolio on your trading merits. Just the fact that you've overcomplicated the portfolio will make it very difficult to gauge whether it's going to be successful or its level of performance. When trading correlation, experienced traders understand gold and the US dollar share a negative correlation, and so they'll never decide to take either a long or short position in both markets at the same time. Understanding the concept of market correlations can not only prevent traders from making very obvious mistakes, but can also help them to gain an advantage over other market participants in developing a trading edge. And that's what we're doing here as traders here. We're always looking to compete against one another to make money, something that perhaps isn't totally available in the markets in terms of a knowledge-based decision or some skill that you have ascertained that can certainly help you develop an edge will, of course, make you more profitable over the long term. Experienced traders use these common correlations within the markets to look for money-making opportunities. Indirectly trading these correlations whilst at the same time trying to avoid short-term volatility. One such trading strategy is known as spread trading. So what exactly does this mean? How can you look at trading correlations and actually look to directly make profit opportunities from trading these correlations, as opposed to just simply preventing yourself from making very poor trading decisions? Again, let's use the oil market, and there's a very basic approach to really explaining why. Because they are two of the most correlated markets, the US crude oil WTI benchmark and the European Brent oil benchmark provide great opportunity for correlation trading. Why? Traders can choose to both buy and sell two markets at the same time. Okay, and that's potentially something that retail traders don't necessarily think about. We're always looking for these great buying opportunities or great selling opportunities just to make a simple trade to the downside or upside and obviously make a profit. But what happens when you find two markets that are very correlated and there's a strong shock in a market? To take maybe an equity index or something similar, if we know that there's going to be outperformance in one sector, and there's severe or very strong correlation within the markets in general, of course we're going to buy that sector because it's strong, and potentially look for another sector to sell, just in terms of hedging that opportunity. So actually looking at these correlations, it's no different. And here we have a very obvious example. Here we have the US oil and UK oil. So what I'd like to do is just to walk you through a trade on this asset class here, the oil market. So here on the left, we have a strong move to the upside. And what we can gauge by this and what the market is really telling us is that there's a strong move overall in the oil market, but for whatever reason, the UK benchmark, the UK oil benchmark is actually outperforming US WTI, and you can see by the relative move to the upside. So what we can look to do there is actually take what's called a spread trade. So within this example, what we'll actually effectively do is we will look to buy the market, of course, because it's a strong move. So we buy the UK Brent, and then we look to take the other side of that trade by selling US crude. What we can effectively see it, there's a price increase in both markets, of course, 55.95 to 57.98 and 61.02 to 64.37 respectively for the US crude and Brent markets. So collectively, that is effectively a 203 pip loser in the US crude market, given that we're selling the market and it's moving higher. But of course, we're buying the Brent market and we're outperforming on the strength of the European benchmark, and it trades up 335 pips. When we actually exit that trade, we have made a profit of 132 pips. So here is a direct example, guys. We're actually deciding to trade these correlations, the very strong correlations within the markets. We're effectively avoiding all of this volatility, and we know that the markets don't simply trade very strongly in one direction. They pull back, and what we're trying to do is just dismay that if it's volatility. This market is traded up at 335 pips in the Brent market, but if you were deciding to scalp that market or to simply buy it and try and hold it, it would of course be pulling back. So if you were scalping, you could have actually bought this market 4 or 5 several times and perhaps taken losers. So this is one opportunistic approach to trading these correlations, that we can avoid the volatility, that we can outperform, perhaps using our knowledge of the strength of the market or the correlation to outperform over one very correlated market. And here we have a very good trade. Overall, we make a profit of 132 pips. One of the best things about financial trading is that there are many different ways to make profit in the markets. Most traders simply focus on buying something and selling it at a higher price, or of course short selling, which is fine and a fair assumption to traditional trading. And that's what we would refer to traditional trading. However, trading correlated markets may provide you with some insight to engineering your own profitable trade opportunities. Let's take another example here. We'll look at the European equity markets. And here we have yet one example. Number one, the monthly German unemployment release was a big miss at 6% in contrast to an expectation of 5.2%. Okay, so we have an expectation, and generally we're seeing these unemployment figures start to be much better, more supportive for the economies. But let's say we have a big miss here. The expectation is 5.2. We have the figure coming out at unemployment in Germany at 6%. The markets are experiencing a lot of volatility in the trading day. So how could we perhaps trade this market? How could we perhaps look at correlations to avoid the volatility and to look and engineer a profitable opportunity for ourselves? Well, here we have two markets here, and I've just outlined one trade for us as well. We have the Euro Stoxx 50 and the German DAX. Now, we know that there is going to be a move in this market, more likely to the downside, given that it's a very poor economic figure there in Germany. 6% unemployment is announced. We know that the DAX will be a very weak market during this trading day. The aim is therefore to profit more from the DAX weakness whilst trying to avoid the volatility. So if we take potentially a short position here, we look to sell the DAX given the weakness and buy the Euro stock. This is something that we're going to find today. We're going to have a move to the downside in both markets, but the greater move is going to be in the weak market, and we can use obviously what is known as spread ratio, which will determine in many of our other webinars here. It's a mathematical equation to actually look to find the spread ratio given there's a pip value for each of these markets. We're likely to find something like a 120 euro loser in the Euro stocks while performing a 270 winner in the DAX. That overall has a profit of 150 euros profit. So we're aiming to, we know that the move is going to be weak. We're aiming to take advantage of this news article that tells us that the markets are going to be weak, European markets, in this trading day. We know that it's a German article of news, which is going to provide more weakness for that equity index. And we're simply spreading it off with a very, very correlated market there, the Euro Stoxx 50, given a lot of those components are actually German companies. And it's an overall benchmark for European equity performance. So with a quick review here on correlated markets, what did we learn throughout this webinar? Well, we first started to define correlated markets and understand why they're actually so important, not just in defining relationships between certain asset classes or markets, but to actually look for opportunities both in spreading risk. We looked at some portfolio management there. We looked particularly at Forex correlation as well, in terms of overweighting an associated level of risk with the Forex pairs. And we looked at actually trying to identify new trading opportunities for us in actually directly trading these correlated markets, whether they be commodity markets or equity markets. We can find these correlations to serve very good trading opportunities for us. So that finishes off our discussion and topical webinar there on market correlations. Thank you very much for joining us on this installment of Courses on Demand by Forex.Academy. We do hope to see you very soon. Bye for now.